All right, the union budget is out, and you know what that means. A whole bunch of new tax changes. It can feel a little overwhelming, I know, but we're going to cut right through the noise. Today, we're breaking down what the direct tax proposals for 2026-27 really mean for your wallet. So let's dive in.
So what's the bottom line here? I mean, beyond all the headlines, how does this budget actually affect your finances, your investments, or maybe even your business? Well, that's exactly what we're here to figure out.
Here's the plan. We're going to start with the stuff that impacts most of us, your personal taxes. Then we'll jump into what's new for investors, cover the new rules for businesses, and then talk about a really big push to make tax compliance a whole lot easier. And to wrap it up, we'll look at a brand new scheme for foreign assets. Let's get to it.
Okay, first up, personal taxes. This is where the rubber really meets the road for most people's day-to-day finances. And this year, the big story isn't about changing the rates, but more about some helpful tweaks to deadlines and exemptions.
So let's get the biggest question out of the way right off the bat. Have the tax slabs changed? And the answer is nope, they're staying exactly the same. So whether you're sticking with the old regime or you've moved to the new, the rates you pay on your income are not changing. That's a little bit of stability for you. But here's where things do get interesting. The deadlines. Now, if you're salaried, your date is still the same, July 31st. But for non-audit cases, you're getting an extra month. The deadline is now pushed to August 31st. And this is a big one. If you need to file a revised return, you now have until March 31st of the next year. That's 3 extra months to fix any mistakes, which, let's be honest, is a huge bit of breathing room. The budget is also making some new types of income completely tax-exempt. This is a pretty big deal. It includes things like compensation you might get if your land is compulsorily acquired, interest from a motor accident claims tribunal, and disability pensions. And there's also a 5-year tax break on foreign income for certain foreign experts, which is a pretty clear signal that they're trying to attract top global talent.
Okay, let's switch gears and talk to all you investors out there. If you're playing in the markets, whether it's gold, stocks, or derivatives, there are a few really important changes you need to have on your radar.
Now, this one is really crucial if you're into gold. You know sovereign gold bonds, or SGBs? Their big selling point has always been that the capital gains are tax-free when they mature. Well, here's the catch. That benefit is now only for the person who bought the bond directly from the government in the first place and held it all the way to the end. So if you buy an SGB from someone else on the secondary market, that awesome tax exemption is off the table for you. And a heads up for anyone trading in futures and options. Your costs are about to go up a bit. The Security Transaction Tax, or STT, is being hiked. Selling options? The rate's up. Exercising them? That's up too. And selling futures? That rate has more than doubled. Now, I know these look like tiny percentages, but if you're an active trader, you know this stuff can really add up over time. There's also a pretty major shift in how share buybacks get taxed. It used to be that when a company bought back its own shares from you, that money was taxed in your hands just like a dividend. Well, not anymore. Now it's going to be treated as a capital gain. That completely changes how you calculate your tax on it. Oh, and for company promoters, there's an extra tax on top of that. Okay, moving on from personal investing to the corporate world. The budget has made some key changes for businesses, and there seems to be a real focus on simplifying a very complicated tax rule while also encouraging growth in specific sectors. So let's talk about the Minimum Alternate Tax, or MAT. It's basically a safety net to make sure big, profitable companies that have a lot of exemptions still pay some amount of tax. For companies that are sticking with the old tax regime, the MAT rate is dropping just a bit, to 14%. But here's the big news. For companies that have jumped over to the new, lower rate tax regime, MAT is just gone. It's not applicable at all.
You know, when the government really wants to pour fuel on a specific industry, one of its most powerful tools is the good old tax holiday. By basically offering a period of zero tax, they can get companies to pour money into certain areas and really kickstart growth.
So who gets to cash in? Well, the big winners this time are data centers and electronics manufacturing. Check this out. Certain data centers are getting a tax holiday that runs all the way to 2047. That's a massive runway. And foreign companies supplying equipment to electronics manufacturers get a pass on taxes here until the 2030-31 tax year. These are very clear signs of where the government wants investment to go.
You know, this next section might actually be the biggest underlying story of this whole budget. It's this very clear, very deliberate push to simplify tax compliance, cut down on legal battles, and just make the whole process less painful for everybody.
And let's start with a jaw-dropper. The tax rate on unexplained income or assets, you know, that super high, punitive 60% rate, they've chopped it in half, slashed it right down to 30%. This is a huge shift, and it feels like a move to encourage people to just disclose things rather than get into these long, expensive legal fights.
And this points to a really big change in mindset. For some technical defaults, say you missed the deadline to get your accounts audited, the government is moving away from bringing down the hammer with a harsh penalty. Instead, it's going to be handled with a simple fee. It kind of takes the fear out of making a small, honest mistake.
They're also creating a new way for people to get immunity. If you've misreported your income, you can now avoid the penalties by just voluntarily paying an extra bit of tax. It gives taxpayers a clear way to fix their own mistakes without facing the worst-case scenario.
And the list goes on. Maximum jail time for many defaults has been cut. The upfront cash you have to deposit just to file an appeal, that's been cut in half, down to 10% of the demand. And a bunch of those confusing procedural issues that have caused endless fights over the years have finally been settled. The message is crystal clear. They want fewer, faster, and cheaper tax disputes.
And finally, let's talk about a major new initiative. It's a one-time window, a chance for taxpayers who might have some undisclosed foreign assets or income from the past to come clean. It's an opportunity for a fresh start.
So, the government has rolled out this new disclosure scheme for 2026, and the goal is pretty straightforward: to encourage people to voluntarily declare any foreign assets or income that they haven't reported before and to bring that money into the formal system.
So how does it work? It's basically a four-step deal. First, you declare the asset. Second, you pay a flat 30% tax on its value. Third, you pay a penalty that's equal to 100% of that tax. So effectively, it's a 60% charge. But in return, and this is the big one, you get total immunity from being prosecuted under the very strict Black Money Act. So yeah, it's a high price, but it offers a final way out.
So when you step back and look at the whole picture, what's the big takeaway? The real story here isn't just one tax cut or one hike. It's the clear theme that's woven through all these changes. The government is signaling a clear move towards a simpler tax system, one with fewer fights, while at the same time using tax policy like a laser to boost growth in very specific sectors. And all of this leaves us with one final question to chew on. We've seen a lot of moves that are aimed at making things simpler. But is the tax system actually getting easier for the average person to navigate, or are we just swapping one set of complexities for another? It's definitely something to think about as these new rules start to roll out. Thanks for joining us for this breakdown.